Coro is all-in-one cyber security, folks, to help you get up to speed quickly, serving over 13,500 mid-market customers. They just broke $18 million in ARR as of the end of 2022, hoping to 300% grow that 300% this year, which means they would need to add about $36 million of new ARR. He says they're on track to do that. They just raised another Series C plus, we'll call it, $75 million at around a $600 million valuation. His team is growing, a lot of talent, 297 folks with concentration up there in Chicago, as they look to continue to scale across their 3 key channels. Hey folks, my guest today is Dror Liwer. He is a serial entrepreneur and investor who took 2 companies public, sold 3, and is now building the world's fastest growing cybersecurity company at Coro.net. It's enterprise-grade cybersecurity for the mid-market. Dror, are you ready to take us to the top?
Absolutely, Nathan.
All right. So before we get into the sort of the customer profile, the product updates over the last year, you did come on the show about a year ago, and I remember you said, quote, Nathan, we're targeting 18 million run rate target by the end of 2022. So my first question is, did you beat your goal?
We did beat our goal.
Congrats. Okay, now tell us how you did it. What are your customers using you for, and how are you growing?
So first of all, our customers are the neglected people in the world of cybersecurity. So the entire cybersecurity industry is focused either on the very rich, the enterprise Fortune 500, or the consumer market. Nobody's focused on the economic backbone of the American economy, the mid-market companies that are actually 65% of the GDP. We focus on these guys, and we provide them with enterprise-grade security in a way that they can actually implement and protect themselves. So we've solved the 4 biggest problems that they've had, and our growth, which has been 300% year over year for the past 4 years straight, with this year expected to be yet another 300% growth, has shown.
You think you'll break a 40 million run rate by December?
Oh yeah.
Yeah, I mean that would be 300%. You're 18 million in 2022, so 300% year-over-year growth would be somewhere above 45 million.
Yeah, so our expectation is to beat that number. And the main reason is we are in this really unusual perfect storm where, on the one hand side, the attackers are changing course and now attacking the mid-market companies and the small businesses as well, simply because A, they can, and B, they're vulnerable, and it's much harder to go after the enterprise, which has, much larger budgets, much more experienced cybersecurity teams, and is a lot better protected. So I always equate this to, if you're a burglar and you're walking down a street and there are 2 equal houses, but one has 2 Dobermans, a barbed wire fence, cameras, and an alarm system, and bars on the windows, and one has the window open, where would you go? Mm-hmm. And that's really what our attackers are doing. The bad guys are going after the people that it's easiest to go and grab. So granted, their ROI is lower on a per attack basis, but they have a lot more of these attacks that they can execute. And now they've automated everything. And with all of the automated tools that are out there, it's much easier for them to execute those attacks. And they're going after these mid-market and smaller organizations.
And Dror, you're very effective at talking to those users, because you told me last year you'd already signed up 4,500 of them, these mid-market folks, to use your tool. They were happy they're using it. Where are you today? How many paying customers?
So it's triple that.
Oh, wow. Okay. So you're up at like 13,500 paying customers.
Oh, what's going on there, YouTube? Good to see you guys. Now imagine this. You love watching these interviews with SaaS founders, but imagine if we took all of the valuation data out from over 2,807 interviews I've done manually. Saves you a lot of time. Well, we've done this. We've built it into the beautiful interface inside of FounderPath. Check this out. I'll show you how you can access this in a second, but you log in, you connect your Stripe account, you see your valuation real time, you can see what it changed over the past 88 days, and even set goals for valuation this year. Now, the secret to valuation is there's many different ways to value a SaaS business. So the reason you're going to see 3 or 4 different valuations inside of your Founder Path dashboard, this is all free by the way, is because depending on who's doing the buying of your SaaS company, you're going to get a different valuation. A VC is going to pay a different valuation. Private equity firm is different. If you're going to do a minority sale, that's different. And if you sell the whole business, that's a different valuation. You can see all those when I hover over here. Right, so the teal is what a VC would pay, yellow is what private equity, and red is if you sold the whole thing outright. Now, what's cool about this is not built off random data. Again, you guys hear these interviews on YouTube. All these data are built from real-time valuation data points founders share with us on the show. So traction, 1.2 million, seed round, 3.7 raise, they sold 22% of their business. Go in here and filter by the event. Maybe you only want to see companies that have sold the whole business. Well, here are a bunch that have been acquired, the valuation and the multiple. Maybe you're going out right now and you're raising your seed round. Well, go in here and look at all this recent seed deals that went down, what they raised, what valuation they raised at, and what percent that they sold. There's never been a larger data set of SaaS valuations than what you can get now inside of Founder Path, and we're thrilled to bring it to you. All right, we're going to go back to the YouTube video here in a second, but if you want to check this tool out, if you want to jump in and sign up, you can check it out for free to get your valuation at this link, founderpath.com/products/valuations. Or if you go to founderpath.com and hover over products, click on get your valuation here and go ahead and sign up to give it a whirl. Again, all that valuation data live right inside the platform. I hope to see you there. All right, let's jump back into the interview.
Wow. What drove most of that growth? Was it an outbound motion, inbound motion? What growth levers did you pull?
So we actually have 3 different motions in parallel that we're going to market with. One is a direct outbound. We have a team in Chicago, very diligent, that is going out and engaging with potential customers and bringing them on board.
How many FTEs on that team?
A total of about 100.
Wow, 100 on the outbound team. Okay.
Yeah. And then maybe I'm exaggerating a little bit. It's more like 80 because I'm mixing up some of the direct with the channel. The second one is, of course, the channel team. Yep. So we are selling through very, very good partnerships that we have with MSPs, with MSSPs, with VARs, with master agents. And they're also using us to open new doors where historically they couldn't sell cybersecurity into the market that we're selling because the offerings were too expensive and too complex and too labor intensive. And now that we've removed these 3 barriers, they are able to go to market and offer a cybersecurity solution to their mid-market customers as well. And the third is through what we call technology partnerships. We have a team that focuses on tech partners where basically we become the cybersecurity component of what they sell.
Name one.
So an example is a company called Comply Auto. They provide compliance software to the automotive industry. So now they also offer security compliance, and that's really us. We are the underlying it. It's not white labeled. It's co-branded, call it.
So is Comply Auto bringing you the customers? Are you billing Comply Auto's customers directly?
No. Comply Auto owns the relationship. The customer knows that they're using a Coro product. We're not hiding that fact, but it's a partnership. The ownership of the account, the ownership of the customer is Comply Auto. We're just providing that cybersecurity engine to make sure that those automotive customers are protected and are compliant with, in this case, the GLBA safeguard rules that they're now supposed to comply with.
Does Comply Auto say, hey, Dror, we want 1,000 seats here because that's what we think we can sell? You say, here's a bulk discount, and then they mark it up, whatever, 50% and then sell it to the end user? Or what's the revenue relationship there? What's the partnership agreement like?
We don't disclose revenue relationships in public, but basically Comply Auto sells a package to their customer. We have a relationship with Comply Auto where they get our product for a fixed fee per seat, and how they mark it up or how they sell it to their customers is their business.
So the reason I'm asking this is what prevents Comply Auto from undercutting a customer that's going to sign up directly on Coro.net? They might see cheaper pricing on Comply Auto.
We're not worried about that. We're not we're not competing with our partners in any way. We actually prefer that our partners win because from our perspective, there is a very strong sales multiplier when you're using partners. So we're not trying to compete with them on those customers. If the customer prefers to buy from Comply Auto, more power to them, more power to Comply Auto. We're very happy about that. Because
why would anyone
their
ever
sales force
if Comply Auto sells it though, like let's say your ACV you told me last year was $2,700, right? So your website lists $2,700, but if Comply Auto lists the exact same thing at $1,000 for a year, basically your partners would effectively cannibalize your own direct revenue. You're saying you're okay with that?
100%.
Okay, cool. And then how is that different from the VAR agreements or the channel team agreements? When you sign up a new channel partner, what is that relationship like?
So very similar. We sell to our partners for a discount of the MSRP, and they mark it up and they add on top of it also their services. So for example, an MSP doesn't just sell product, they sell a service. They help manage the platform on behalf of their customers. So from their perspective, their offering now is a lot more complete. And what we can give the MSP beyond that margin or that discount the haircut that they can get from it, they're actually getting a lot more from it because they are getting a new market open to them because now they can offer cybersecurity at a very reasonable cost to a customer to whom they could have probably offered only antivirus in the past. Because the price points are just so difficult. And beyond the price point, maintaining a security stack is a very expensive thing from an HR perspective. And what we offer that customer, that MSP, that partner, is the ability to offer a stack that manages pretty much itself because of the engines that we have. So there's a lot less work that a human needs to be doing. So we've removed more than 95% of the human element through AI, through automation, so the same team can now support a whole lot more customers from an MSP's perspective, so now I can go out and sell it at a very reasonable price.
You're helping MSPs expand their margin.
Absolutely. And expand their foothold within their existing customers. And, in the MSP world, it's all about stickiness.
Wallet share.
Yeah.
That makes tons of sense. Have there been any drastic change? You told me last year your average customer is paying about $230 a month. Has that changed drastically, either up or down, or is it about the same?
Yeah, it's changed significantly. So first of all, with economics being what they are, we've raised our prices a little bit. So last time we spoke, our prices were at about, they were about $6 per user. Now they're at about $8.99 per user. So that increased, but also the size of our customers has grown significantly. So now we're seeing customers that are more in the 700 seat range. Whereas when we last spoke, the range was more about 150 to 100 maybe.
Yep. Okay. So I guess what does that mean in terms of the average annual contract value? Like maybe it's now instead of 3,000, it's looking more like 4,000 or 5,000 on average per team.
It's actually more like 9,500.
9,500. Okay, per team per year. Interesting. Do you have any $1 million accounts yet?
$1 million accounts? Well,
Correct.
If you look at our partners like MSPs or master agents, then they would be considered 7 digits because they come with a bunch of seats. They come with 3,000, 4,000 seats, 10,000 seats sometimes. So those are big accounts. But as an individual account, the answer is no, because our focus is mid-market. And the mid-market, but the way we define it, is up to 5,000 seats. So if you do the math at $8 per user per month at 5,000, you'll never get to $1 million.
Yeah,
but we're not even aiming.
You should have $500,000 accounts here in the next year if you don't already.
Yeah, so there are some accounts that are beginning to get to that point.
Yeah, that makes sense. Now, help me understand. My math is wrong here. If I take 13,500 customers at an average 9,500 per year, that puts you at like $128 million in revenue. So that 9,500, I'm guessing that's not the average, right? Your average is lower than that.
No. Yeah, absolutely.
Okay.
There's a range. The average is, so we're tracking, like every SaaS company, we're tracking a rolling average of where the accounts are going. So the average, it has been moving up over time as the customer size has been growing. So if I'm looking at the last month, that's the average. If I'm looking at the average across the year, it's a little bit lower.
I see. You're looking at average new signups last month are signing 9,500 annual contracts.
Yeah.
Yeah, I see. Now, help us understand growth, because it's obviously important. It's really hard to grow right now. So I want to give you a lot of credit where you're growing. If you finish 2022 at your target of that $18 million run rate, now we're 6-7 months into 2023. What is monthly recurring revenue today?
So we don't disclose that publicly, but let's say that we're on target to tripling our revenue this year. We beat our number in Q1. Q2 is shaping up to be so we obviously have a plan exactly of what needs to happen every quarter. So in Q1 we beat our number by about 8%, which was a great thing. Mm-hmm. And then this quarter looks like we're going to hit our number again. And the next 2 quarters, there's no reason to believe we're not going to meet what we expect to hit.
Just to understand your quarterly targets, if you finished last year at 18 million and you want to grow 300% on top of that, that would mean you need to add 36 million of net new ARR this year. If you divide that by 4 to get down to the quarterly numbers, you can sort of get to, I imagine, what your quarterly targets might look like. I guess, what outside of the 3 revenue channels, or the 3 channels that you just described, I mean, why so aggressive? I mean, I know you raised an 80 million Series C, and you told us that was around a 500 million valuation last year, but are you getting just tons of pressure from the board to grow at all costs?
Actually, there's news on that front as well. We raised an additional 75 as a C2.
Okay.
So the total raise was 150 in April.
Of this year?
Yes. So we've completed, or we've added, like, call it a C2, whatever you want to call it, a C, and another 75. So a total of 155 in the last 12 months.
Did you give the new investors at 75 million the same value, the 500 million valuation, the same valuation of the earlier folks?
No, there was a little bit of yeah. There was so we're very fortunate because our valuation has been growing, whereas I'm sure you know that a lot of the valuations in the market have been going the wrong direction. Mainly because a lot of the valuations in, let's say, 2020 or 2019 were a little overpriced. So our valuation has been growing. So the last valuation was about 20% higher than 1 year ago that you knew about the 80 million.
So call it 600 million for the second 75 million round, something like that.
Very close to that, yes.
Was that primary money or secondary?
Primary.
Okay, so it's on the balance sheet for operations.
Yeah, absolutely. It's
Yeah. Okay, that makes sense. And then, I mean, the reason I was going on this valuation train is there's a lot of founders at your same stage that I talked to that say, man, I wish I didn't raise at such a high valuation last year because now option grants are underwater. With 12 million in ARR, when you did your Series C, the first 80 million at a 500 post, that was a 41x multiple. Do you regret raising at such an aggressive, many people call an aggressive multiple today?
No, because we were able to raise again at a very aggressive multiple this year. And we are showing phenomenal growth, both ARR, customer base, in every aspect of every KPI that we're measuring. We're showing phenomenal results. So from an investor perspective, when you look at a company and you analyze a company, and having been an investor, having been on the, the dark side of the VC world, I can tell you, you look at KPIs, and that's how you make a decision. So when a company, despite the economic downturn that we're experiencing out there, despite everything that is going on in the market, is able to show that kind of aggressive growth, you understand that there is something unique about Coro. and that's really what's happening.
But your valuation multiple compressed. You didn't raise a second 75 million at a 41x multiple. It was like a 25x ish multiple based off my math.
Yes, but it's still an amazing multiple, considering that the numbers we're hearing in the market today.
Do you worry? I know, I agree. And that multiple is way higher than others at your stage that I'm seeing. I mean, but I don't know that you could brag about it, but I don't know if that's a good thing to brag about. I mean, do you worry about growing into that valuation?
We don't think of it that way at all. We think that the valuation was very fair because valuation represents the potential moving forward. And as we've shown that we've grown in the year that has passed since the previous fundraise, we've shown that we've again tripled our growth. And this year we're expecting to do the same. I think that from an investor perspective, when you look at those kinds of KPIs, you're looking at the potential, the growth moving forward, and being that we were able to hit our quarterly commitments for 48
months.
For 12, I'm sorry, for 12 quarters, 48 months, I meant, for 12 quarters straight, it gives a lot of confidence to an investor to come in and say, you know what, these guys know what they're doing, and they're executing. It's not a dream anymore. It's execution, and this is what the machine is all about right now.
And those of you that missed the first interview with Dror a year ago, the company launched in 2014, raised a 1.5 seed, raised 5.5 Series A in 2016, and another 20 million Series B in 2018. So it's not like this wasn't a 2-year overnight success thing. He's been at it. He's been consistent for almost 10 years, cranking along, which is great. Dror, help me understand the team size today. How many full-time all in?
Just under 300. I think we're 290 something. So we're about to hit the 300 number.
How are you thinking about you? I mean, I imagine you raised 150 million over the past 12 months. I imagine, well, I'm guessing more than 100 million is still in the bank. How are you thinking about using that cash in a world where folks are cash poor sometimes? Can you go buy up competitors at cheap discounts?
So that's a great point, Nathan. So we're looking at the money being used in 3 different ways. One, of course, increasing our R&D expenditure and making sure that we continuously invest in the product. 2, investing in the go-to-market. So granted, I'm sure all of your listeners understand this kind of aggressive growth costs money, and being that we're growing from a larger base, the 300% growth requires a lot of capital. And 3, you're absolutely right. We're definitely looking into potential acquisitions to increase our portfolio through acquisitions. So both organic and inorganic.
That makes sense. Now, do you still have over 100% net dollar retention?
Yes. We're at about 106.
Okay, yeah, it was 105 a year ago, so that's good. You've been able to hold that, which is nice. And then what are you willing to pay today to get a new customer that's paying you $10,000 a year?
So normally our cost of acquisition is about 8 months.
Okay.
Which is in line with what the SaaS industry is all about.
So you'll spend $7,000-8,000 to get a $10,000, $12,000 a year customer.
Yes, our lifetime value though is a lot more than that, because normally, so the cohort that signed up with us in 2019 is still with us today. So so far we're running a 4-year lifespan, and hopefully it's going to be even longer.
So do you assume, and this is all sort of guessing, but do you imply a pro forma lifetime value of something like $50,000-$60,000 on these accounts?
At least 40, but most probably on the higher 40s.
Yep. Very cool. What else? What else do you wish people like me asked you about, but you never get a chance to talk about?
No, you always ask all the right questions, Nathan.
All right.
It's been an incredible year for us, and I'm extremely proud of the team. We've grown the team tremendously. And both we have a massive office in Chicago right now. This is where our sales center is. So we have well over 200 people just there. It's an amazing team. I mean, we just moved to a new office. We took over an entire floor in a building. It's really great as a founder to see that kind of development. And when I show up, sometimes it's kind of weird because as a founder, you show up and there's a whole bunch of new faces. It's heartwarming, but also very strange not to know everybody.
So if we want to host a big SaaS Open in Chicago and we were going to bring 300 founders with more than 5 million in ARR in all together, we can use your place to host it?
For a small fee, for sure.
There's the sales guy. All right, Dror, let's wrap up here with the famous five. Number one, your favorite book.
Oh, what is my favorite book now? I have to say it's still The Tipping Point.
Tipping Point. Number two, is there a CEO you're following or studying?
Still Elon Musk. Despite all the controversy, I think the man is a genius, and despite every strange aspects of both his behaviors and some of his decisions, I still think the man is somebody to be reckoned with.
Number three, what's your favorite online tool for building Coro?
Oh, wow. There's so many. We're heavy users of Monday these days, and it really helps keep everybody together, especially when we're across geographies, across time zones.
And number five, how many hours of sleep are you getting?
On average, 4 a night.
Dror, come on, that's not healthy.
I'm naturally an insomniac, so it's not just because of Coro. It's because I am an insomniac.
That's fair. Okay, and situation, married, single, kiddos?
Oh yeah, I'm very much married. Have been married with the same wonderful woman since 1990. So
wow, and 2 kids, right?
And 2 kids. You're absolutely right.
Okay, and I think you had a birthday. You're 54 now?
I am actually turning 55 next month.
Oh, very good. Okay, so I must have caught you on the back end of your 53s. So, yeah. 54 now, 55 coming up. Happy early birthday. And last thing, something you wish you knew when you were 20.
Invest early. I think I said that last time. Had I known what I know today about investing and creating wealth, I would have done it.
Coro is all-in-one cyber security, folks. They help you get up to speed quickly, serving over 13,500 mid-market customers. They just broke 18 million bucks in ARR as of the end of 2022, hoping to 300% grow that 300% this year, which means they would need to add about $36 million of new ARR. He says they're on track to do that. They just raised another Series C plus, we'll call it, 75 million bucks at around a 600 million valuation. His team is growing, a lot of talent, 297 folks with concentration up there in Chicago, as they look to continue to scale across their 3 key channels. Dror, thanks for taking us to the top.
Thank you very much, Nathan. Always a pleasure to be with you, speaking with you.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers, they try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company, or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them, and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.